Well, we're going to get more insight now from someone who knows all too well about the inside workings of the Federal Reserve. Our next guest, Andrew Levin, former Federal Reserve Board Special Advisor and Dartmouth College economics professor. Thank you for joining us. So now we do have the basic here. We know that we're going to see this 0.5 percentage point interest rate hike. This is something that you said in your notes that you were expecting. But as we anticipate perhaps further rate hikes, some people are even saying 75 basis points. Is that something we can expect then, given the late start that the Fed had to this?
Well, it really helps to start with the big picture here. So inflation's running at 8%. Consumers actually, according to the New York Fed survey, are expecting inflation over the next 12 months to be around 8 to 9%. So they're not seeing any relief in sight. The latest wage data that we got from the quarterly survey of employment compensation for private workers is up around 6.5% at an annual rate. So that means workers are trying to get cost of living increases just to catch up to the inflation. And that wage price dynamic is ongoing. What economists think about is the difference between interest rate and inflation. And right now, that difference is very, very negative. Think about it, like a positive 8% inflation rate. And now the Fed's just starting to raise interest rates up to positive 1%. That's a huge gap. Where we think the neutral level of monetary policy is when they raise the interest rate up to be roughly consistent with inflation. So in that perspective, the Fed has a long way to go. So probably 50s, maybe some 75s. We could see a 1% rate hike this year. If inflation keeps running at 8 or 9%, or even heading up toward 10, I think the bond markets are going to realize the Fed has a long way to go.
Well, so Andrew, going off of that, because we've heard some criticism directed at the Fed. Jamie Dimon, CEO of JP Morgan, was the latest one, or one of the latest people to really say that the Fed should have simply raised rates sooner. In your view, do you think the Fed is behind the curve?
Yes, they're behind the curve, but there's no point in criticizing the past at this stage. Okay, the question is how to move forward. And I think I was personally disappointed today that the changes in the actual statement that they issued at 2 o'clock weren't very clear. Okay, what we need to hear from Chair Powell in a few minutes is a strategy. Now, he could say clearly that their strategy is to bring the level of interest rates up to be roughly in line with the level of inflation. Okay, and if we're lucky, inflation could come down from 8% to 5% by the end of this year, maybe even below 5%, but that would probably be good luck. All the factors the Fed itself said today that the supply chain disruptions are probably getting worse. We know about Russia and Ukraine. That's probably making things worse in terms of commodity prices and energy. Okay, we know that workers are trying to catch up with cost of living increases. We know that rent prices are skyrocketing. All these things are putting upward pressure on inflation. So the Fed needs a strategy. The strategy should start with saying we're going to move to neutral, and neutral means an interest rate that's roughly similar to the level of inflation, and they're going to move as quickly as they need to get to neutral roughly by the end of this year or early next year.
You threw out the word luck, and the word luck is often tossed about in order to avoid a recession. And Janet Yellen today said the Fed will need to be skillful and also lucky, but I believe it's a combination that is possible. That's not exactly Reagan-esque optimism about our economy. What do you make of that statement, and do you think we can avoid a recession?
I don't think there's any need for the Federal Reserve to create a recession, or even to create a risk of a recession at this point. Okay, of course a recession could happen due to some other terrible factors. Okay, but moving to neutral is not a contractionary stance. It's not a restrictive stance of monetary policy. That's a stance that would just help stabilize inflation, keep it from going up any further. Okay, so right now monetary policy is still adding fuel to the inflationary inferno. It's still adding fuel. Okay, the point about bringing the interest rate up to be roughly consistent with inflation is that's the point at which they're no longer adding fuel to make the inferno worse. Then they're going to have to figure out how do they start bringing inflation back down. But that could be a more gradual process. The recession could happen if the Fed is lurching if people are confused what the Fed's plans are, if workers are discussing with their employer about wage increases and no one really has an idea what the Fed's planning to do about all this, that could exacerbate the risk of recession. And on the other hand, if the Fed is really clear about its plans and its strategy, that will help reassure people, and we can avoid a recession.